Welcome to another Bitcoin deep dive by My Crypto Paradise. Whether you're prepping for your day or just looking for that edge in the markets, we are incredibly glad you're here.
Yeah, we really are. Consider us your guides and honestly your sounding board.
Exactly. And most importantly, your family in this space. When you are with us, you are part of the Paradise team.
That's right.
So today we are unpacking an urgent and pretty profound market analysis straight from our internal VIP research desk, from our very own Paradise team expert, Simon.
And it is a crucial one.
It really is. We're currently sitting at a critical juncture where the data is pointing toward a potential 36% drop for Bitcoin.
Which could bring us down toward that $44,000 level.
Yeah, but we're not going to just throw arbitrary price targets at you.
No, we are going to look under the hood. Because this deep dive isn't just about moving averages or trend lines. It's fundamentally about the ultimate psychological battle in crypto.
The mindset.
Exactly. We are dissecting the professional trading mindset versus that pervasive gambling mentality.
Right, because if you spend enough time in these markets, you realize that behavioral biases are the silent killers of portfolios.
The absolute killers. They're the reason why the vast majority of people eventually lose everything in the long run. I mean, even if they catch a lucky break in the short term.
Yep. The charts we look at every day are really just a visual representation of human psychology. It's the raw data of fear and greed.
And the systemic transfer of wealth from the impatient to the deeply patient.
Okay, let's unpack this, because the core of the recent Paradise team analysis centers around a frankly sobering, real-world case study.
It's rough to look at.
Very rough. We're looking at the footprint of what Simon classified as a mucky Big Brother whale. Based on the on-chain data and the order flow monitoring on the Hyperliquid exchange, this entity started with $74 million back in September 2025.
74 million.
Yeah. And over a brutal 2-week period, during some intense market chop, they managed to systematically destroy that portfolio.
Down to what was it again?
They dwindled a $74 million account down to a mere $8,000.
8,000. From 74 million. A wealth destruction event of that magnitude is just staggering.
It is.
But when we view it through the lens of behavioral science, it follows a tragic but completely predictable pattern. This entity, despite wielding all that capital, was operating entirely within a gambling paradigm.
They were just rolling the dice.
Basically, yeah.
Yeah.
The order flow data shows they were utilizing high leverage, particularly trying to force trades on Ethereum during highly volatile windows.
Right, and the fatal flaw was succumbing to the most classic behavioral traps. They were persistently attempting to long the absolute local tops.
Buying into sudden price spikes at a pure FOMO.
Exactly. A desperation to catch the breakout, and then subsequently attempting to short the absolute bottoms when the panic set in.
They were trading purely on emotional impulse, reacting to immediate micro-time frame noise rather than anticipating the macro structure.
And a massive contributor to that noise is the external news cycle. The analysis highlighted how retail participants continually fall into the trap of believing that geopolitical news is the primary driver of market direction.
Oh, the news trap. It gets them every time.
Every single time. We've obviously seen significant geopolitical tensions recently involving Iran and Israel and the USA. And looking at this impartially, simply as market data, the reaction is always the same. When these major headlines hit, the retail sector reacts with pure emotion.
They operate under the assumption that a geopolitical conflict mandates an immediate market crash. Or conversely, that a diplomatic resolution means Bitcoin is instantly going to break all-time highs.
Right. This hypersensitive, news-driven emotional state actually just pushed the fear and greed index up to an incredibly dangerous level of 80.
What's fascinating here is that professional traders and market makers operate with the understanding that news events do not organically create the core directional moves of the market.
They don't.
No, the news merely acts as a catalyst for pre-existing liquidity structures. If the order book and the technical structure are primed for a major retracement, a negative geopolitical headline is simply the spark.
It just ignites the fuel that's been accumulating for weeks.
Exactly. But the retail trader, constantly scanning social media and reacting on impulse, feels the fear or the euphoria of the headline and executes a trade based on that biological response.
completely ignoring the structural reality of the chart.
Completely.
And that biological response usually translates to a very specific and highly destructive action. The data from our research desk points out a brilliant statistic. Roughly 96% of retail market participants utilize market orders.
96%.
Yeah. When they see a massive green candle aggressively pushing up on a daily or 4-hour chart, their analytical brain just shuts down.
And behavioral bias takes over.
Yep. They see that momentum, their brain perceives a fleeting opportunity, and they physically hit that market buy button because the psychological pain of missing the rally is greater than their framework for risk management.
They aren't executing a calculated plan. They're surrendering to a reflex.
A total reflex.
And that reflex is precisely what provides the hidden mechanics for how institutional volume is actually processed.
Explain that for the listeners.
Well, for every reactive buyer hitting a market order, there has to be a counterparty. When we analyze how professional smart money maneuvers around this retail liquidity, it's an entirely different operational model.
Because they're handling hundreds of millions of dollars.
Right. Consider the logistics. An institution looking to offload a massive position absolutely cannot execute a market sell order.
The slippage would be catastrophic.
It would. If
Right.
they dump $100 million of Bitcoin into the active bids side of the order book all at once, they'll eat through all the immediate buyers and crash the price against their own execution.
Resulting in terrible average fill prices, they would be their own worst enemy.
Precisely. So the alternative is they have to distribute those holdings with surgical precision. They have to mask their exit.
So distribution is really a highly calculated game of patience.
It is. A professional desk might deploy an algorithm to systematically sell just 2% of their total portfolio. Then they pause.
They just wait.
They wait. Maybe 10 minutes, maybe an hour, allowing the retail buyers to step back in and for the order book liquidity to replenish.
And once the bids are stacked again, they place limit orders to offload another 5%.
Exactly. But the critical takeaway for you listening is this. The active liquidity that institutions absolutely require to execute these massive distributions at favorable prices is eagerly, almost aggressively provided by those emotional retail traders.
Wow. So the trader mashing the market buy button at the top of a green candle expansion is literally serving as the exit liquidity for the professional.
The pro who is quietly, methodically stepping out of the market. Yes.
It flips the entire narrative.
Yeah.
The retail trader genuinely believes they're catching a breakout confirmation, but structurally they're just walking into a distribution block.
And the dichotomy in risk management between these two groups makes this even more glaring. We go back to that mucky whale who evaporated $74 million using high leverage.
Right.
When we track actual smart money wallets and institutional flows, they utilize incredibly low leverage, often just 1x or 2x or 3x, or they're operating purely in the spot markets.
So when we see a massive sudden spike in open interest accompanying a violent green candle, it rarely indicates smart money initiating fresh longs.
Almost never. It almost always indicates over-leveraged retail participants dogpiling into the move, which mathematically signals a very low probability setup that's ripe for a reversal.
This naturally leads to the question of what the professionals are doing while the retail sector is chasing these spikes. And Simon's analysis utilizes a phenomenal tactical analogy here.
The sniper analogy?
Yes. Capital must be treated as ammunition. Think of your portfolio as bullets in a magazine. In a choppy, volatile sideways market, if you are firing randomly at every single lower time frame green candle that flashes across your screen, you're systematically depleting your ammunition on low probability setups.
And the tragic result is that when the macro target finally presents itself...
Like that $44,000 reaccumulation zone.
Exactly. When it finally hits, your magazine is empty. You have no capital left to deploy.
Professional traders operate with a sniper mentality. They don't run and gun.
No, they stay hidden, they preserve their capital, and they wait for days, sometimes weeks, for the perfect structural alignment where the systemic risk is minimal and the reward is asymmetric.
And that sniper mentality requires a brutally honest assessment of the current market environment. The research team's current tactical stance is a prime example of this discipline.
Right, because the market has been compressing in this tight chop below major macro resistance levels, the Paradise team is treating the overall structure with bearish tactics.
A gambler looks at resistance and tries to predict the exact moment the bulls will smash through it right, wanting the ego boost of predicting the bottom.
But a professional trader couldn't care less about predictions. A professional waits for the market to print undeniable proof.
The proof is in the structure. until the market can demonstrate a confirmed five-wave upward impulsive structure that cleanly breaks and holds above major resistance, the trend remains dominant.
And right now, below those key levels, the trend favors the bears. So bears are best friends. It's about aligning yourself with the side of the order book that is currently exhibiting control.
Rather than fighting a localized downtrend because you have a hopeful bias about where Bitcoin should be priced by the end of the year.
Deploying hope instead of strategy is how accounts get drained. And we see the same hopeful bias in how retail traders manage their invalidation points. The approach to stop losses often completely ignores the reality of market noise.
Yeah, a common retail tactic is to enter a trade and place an incredibly tight stop loss.
The psychological reasoning is that on paper, it makes the potential risk percentage look negligible, which comforts the gambler's anxiety.
But the structural reality of that placement is usually fatal because they place those stops right below obvious immediate support levels.
Okay.
They look at a round number, say $59,000, and place their stop at $58,950. But the market makers can see those clusters of liquidity. They know exactly where those stops are sitting.
The market naturally fluctuates, and market makers will intentionally sweep those obvious lows to grab that liquidity.
And the retail trader gets stopped out by a momentary wick-ho, the noise of the market right before the price reverses and goes exactly where they originally thought it would.
It's so frustrating for them.
Yeah.
But a professional manages risk holistically. If the macroeconomic thesis is a multi-month play targeting $169,000 Bitcoin, placing a stop loss based on a 15-minute chart fluctuation is entirely counterproductive.
Professionals place their invalidation levels safely outside the structural noise. For instance, putting a macro stop loss decisively below the $44,000 region.
Now, doing that requires a drastically different approach to position sizing to ensure the total portfolio risk remains small.
But it guarantees that you're only removed from the trade if the fundamental market structure breaks. Not because a high-frequency trading bot decided to hunt a localized liquidity pool.
Here's where it gets really interesting, because maintaining this kind of sniper discipline requires highly specific technical confirmations.
The Paradise VIPs aren't just sitting back and guessing that the market leans bearish. They are tracking advanced data signatures.
One of the most critical lie detectors we have in technical analysis is the divergence. Let's look at the Bitcoin Dominance Divergence that Simon recently flagged.
This is a textbook example of reading the mechanics beneath the price action. Over a recent period, Bitcoin's price was essentially flat, consolidating around the $69,000 mark.
It was chopping sideways, printing equal or slightly lower highs on the daily time frame.
However, simultaneously, Bitcoin dominance, the metric tracking Bitcoin's market capitalization relative to the entire rest of the cryptocurrency market, was aggressively printing higher highs.
And for you tracking this, that creates a massive structural contradiction. If Bitcoin's fiat price is stagnant, but its dominance over the market is rising, it mathematically dictates that capital is actively hemorrhaging out of the altcoin sector.
But because Bitcoin's price wasn't actually climbing, that migrating capital wasn't driving Bitcoin up.
It means liquidity was either exiting altcoins straight into fiat, or it was flowing from altcoins into Bitcoin, while large-scale Bitcoin holders were simultaneously distributing their bags into fiat.
Creating an artificial ceiling on the price.
Exactly. That is a massive distribution signature. It's a fundamental, structurally bearish warning light that completely evades the retail trader who's only staring at a basic price chart waiting for a breakout.
And that macro distribution signature is currently being corroborated by multiple technical frameworks. The analysis points to severe MACD bearish divergences on the 4-hour timeframes, where price attempted to push higher, but the momentum oscillator actively degraded.
Furthermore, we're seeing explicit candlestick psychology play out at resistance, the appearance of shooting star formations and bearish engulfing structures.
The shooting star is such a violent visual representation of liquidity hunting. For those visualizing the chart, it's that candle with a tiny compressed body at the bottom and a massive long wick pushing up.
Mechanically, what happens during that candle is that retail participants see the price starting to break out. They pile in with leverage, driving the price up.
But the moment it hits a premium level, the smart money steps in with massive limit sell orders, aggressively dumping their distribution blocks into that retail demand.
And instantly squashing the price right back down to where the candle opened. The long wick is literally a graveyard of trapped retail longs.
Which is why we have to contextualize these localized traps within the broader historical cycle data. The cryptocurrency asset class operates in very distinct macro cycles.
And as institutional capital deepens the market's liquidity, these cycles mature and compress. Historically, we observe decreasing volatility with each successive cycle.
The mathematical modeling suggests that the severity of major cycle retracements is compressing by roughly 10% each iteration.
So when we apply that historical decay rate to our current market position,
Hmm.
it projects a structural drawdown of approximately 36 to 39% for this current cycle.
Which aligns flawlessly with that major macro support level near $44,000 that the Paradise team is targeting.
The confluence is what makes the analysis so robust. You have the historical math, the order flow distribution, and it all maps perfectly onto the Elliott wave structures our researchers are tracking.
Yeah, the internal data suggests we're currently navigating an ABC expanded flat correction. Now, to visualize this, the market takes an initial shock downward, which is the A wave.
Then it rallies back up in a B wave, which acts as a massive bull trap, tricking retail into thinking the correction is over and new highs are imminent.
Finally, it rolls over into the C wave, a devastating flush that wipes out everyone who bought the trap.
The Paradise team is patiently waiting for the 5 distinct internal subwaves of that final motive C waves to complete their sequence. They are letting the entire complex structure play out entirely before they even consider deploying their capital.
If we connect this to the bigger picture, the absolute defining chasm between the entity that evaporated $74 million and the consistently profitable institutional trader is pure discipline.
Sustained long-term profitability in this space has absolutely nothing to do with outsmarting the market on every single 15-minute fluctuation.
It's an exercise in mastering your own psychological impulses. It's about managing your capital with ruthless mechanical efficiency.
It's the deep understanding that sitting on your hands refusing to trade the chop and waiting for structural systemic confirmations is actually a highly active and deeply profitable trading strategy.
It's the only strategy that survives. Look, we know this ecosystem can be uniquely terrifying. The crypto market is quite literally a mechanism designed to extract wealth from the impatient emotional retail sector and transfer it to the calculated patient professional class.
It can feel like you're swimming in a dark ocean surrounded by apex predators.
But that is exactly why the My Crypto Paradise brand and the Paradise team exist. We are here monitoring these complex Elliott wave structures, tracking these hidden distribution blocks, and analyzing the on-chain data 24/7 so you do not have to navigate these incredibly dangerous waters isolated and alone.
Relying on a professional, systematic approach, anchoring your decisions to hard data instead of your biological emotions, is the definitive way you survive this chop and ultimately thrive when the real opportunities present themselves.
It requires a paradigm shift. You have to transition from a mindset of constant reaction to a mindset of structural anticipation.
When you truly internalize the behavioral science and the liquidity mechanics driving these charts, the market ceases to be a casino. It becomes a rational mechanism governed by predictable rules, psychological rhythms, and observable order flow.
A mechanism that you can master if you have the right guides. As we wrap up this deep dive, we want to leave you with a final thought to really process before you open your charting software again.
Something to really think about.
If you were to completely disconnect from all crypto news aggregators, permanently mute the social media hype, and ignore every single influencer's panic or euphoria starting tomorrow, how drastically would your execution strategy improve simply by observing what the liquidity and the market structure are actively doing?
Take a moment to audit your own behavioral biases before your next trading session.
Remember, you are part of the Paradise team now. Until next time, stay incredibly patient, protect your capital, and as always, trade smart.